This episode is brought to you by 10 East. Longtime listeners know I've invested in private markets quite a bit myself, but with access to these markets broadening, it can be hard to know where to find vetted, high-quality offerings. That's where 10 East comes in. 10 East is a platform where qualified investors can co-invest on a deal-by-deal basis across private equity, private credit, real estate, venture, and other one-off opportunities typically unavailable through traditional channels. They're founded and led by Michael LaFell, who spent his early career building Davidson Kempner and who invest material personal capital in every offering they bring to the platform, aligning interests with 10 East members who co-invest at their discretion. Join numerous founders, executives, and portfolio managers from leading investment firms who use 10 East to diversify their personal portfolios. Inquire for membership at 10east.co. That's the number 10east.co. Welcome back, everyone. We got an awesome episode today. Our guest today is Herb Greenberg. Spent more than 40 years as a financial journalist, starting with print, then online, and stops at thestreet.com. MarketWatch, his latest business is Wall Street Beats, an online investment media platform. I'm super excited to talk to him about. Herb, welcome to the show.
Hey, I'm glad to be here, Mib.
The first time I met you, it was also virtually, and this was back when virtually wasn't really a thing. This would have been the spring of 2000. I was an undergraduate at the University of Virginia studying engineering, but I was taking an investment class and you were a guest speaker. I don't even know what technology we used back then. It was like whatever the very expensive version of Zoom would have been. Let's place you on the timeline. Where would you have been in 2000? Would that have been at the Street? Are you still at the Chronicle? Where were you?
That was at thestreet.com. I was in New York. My guess is you were in John Griffin's class, I would suspect. And what he had was in those days, John Griffin he's still around, but he had a hedge fund then, Blue Ridge Partners, and he would have me come in once a year or so and talk. And he had this in those days, it was a teleconferencing system in his conference room that only a hedge fund could afford to set up. And so it was me coming in, talking about whatever I was doing in those days and imparting what then really wasn't the wisdom I might have today, even though arguably your wisdom keeps evolving, as I hope I continue to. So yes, I was at thestreet.com. I'd been there for 2 years at that point. It was a very great time. It was a very different time in journalism, and things were changing because we were sort of breaking a bunch of rules back then, and it was a newsroom unlike any I probably have ever been at, because it was a very unconventional with a lot of sharp-shouldered people, all about 15 years younger than I was, and some even younger. And they all were very spirited, and their approach to journalism was sort of, just go for it. And because it was online, you had a little bit more leeway, and you didn't have to worry about deadlines, and you could come out and try to beat the print publications. And slowly, and not slowly, by then we were pretty much making a name for ourselves. So it was a lot of fun.
Let's test your memory, because the thesis for that class is you had to present a stock, long or short. And this was about the most fertile period in history to be doing short research. My long idea, I was a biotech engineering student, so I wasn't a business school student. So my idea was human genome sciences, which I think from the time the class started to ended, it probably went up 300% and down 80 round tripping. Do you remember anything you would have been writing about in the spring of 2000? I mean, my goodness, it was probably endless, the amount of material.
I have no idea, because the spring of 2000, we're talking right
at the peak of the internet bubble.
Everything we were doing, because we also had a show we were doing on Fox, which was really, I think it was around the same time. And it was really complicated because Jim Cramer, me, and several others would be on the show. And it was really hard. We did this on a Friday night. And as the market was really rolling forward, and everyone would come in, and Jim would be talking some of the internet stocks, and I'd be going, wait a second now, these things have no earnings. And what I would do in those days, by the way, because you only have so much bandwidth, I'd go down to the risk factors that the analysts would put in. This is what could go wrong. And that's what would be my counter argument to any of the longs, because nothing made sense. Everything anyone was talking about as a company to own back then was just based on a wing and a prayer. And maybe this was going to be the one, or look at the eyeballs there. And you're going, what are these metrics? So I go down, and I have to tell you, more times than not, those darn risk factors, they were the reasons you wished you had paid attention, because the analysts were covering themselves because they themselves knew that many of these companies would never amount to anything. And back then, It was already past. You were doing biotech, and biotech was, at that point, I think we were already in the second wave of biotechnology, because early on, when I was writing about the biotech companies in San Francisco, back when I was at the San Francisco Chronicle, in the first iteration of public biotech companies, probably 10 years earlier, what I learned was a very important lesson, is that nobody knew anything, and everybody knew somebody who supposedly knew somebody. Everybody knew a doctor. Everybody had some inkling on how this drug would do. And that's where I first learned that I didn't study biology, and I certainly didn't study biotech or anything along those lines. I learned a very basic lesson, and these are all basic lessons. It's until phase 3, you don't know. And everybody can think they know, but those phase 3 results, they're the results that matter. But between phase 1 and phase 3, especially back then, man, the stocks would just go up based on, you just know. And then you learned another lesson about biotech. And the other lesson you learned about biotechnology was that it's not just now that it gets through phase 3. It's okay, it gets through phase 3. There's been a lot of hype. Now, how big is the market? Is it really going to be a great market? Is it going to be? So we learned a lot in iteration 1. And then the other iterations we've just learned going forward, what works, what doesn't work, and how powerful the biotechnology was. I know that's not where you're going here, but it just is all a part of the same thing, because you're dealing with companies that have no profits, that have no cash flow, but are developmental, and they're growth companies. And I learned a lot through covering these growth companies and realizing how many I got wrong writing about them, how many of the shorts I spoke to got wrong in shorting them, because it's all a constant process. The markets are changing. The markets were changing. The structure of the markets have changed. It's a new world, but yet it's the same thing. It's just variations on different themes. Second verse, same as the first, just with a few little tweaks.
Let's dig in there, because I've heard you mention this comment that markets today are structurally different than 20 years ago. To me, that's like always the constant as things are changing. So what looks different? What looks similar?
It's easy to say the markets are broken. And some people who are much well versed in market structure than I certainly am can say that and can point to different things. But it's really, market structure has changed in the variations. And there have been a variety of people out talking about it. There was a very good interview with David Einhorn a while back that basically laid it out. He's a hedge fund manager, Greenlight Capital. He's been around a long time. And I would tend to agree with his view. And Mike Green is another analyst who's been writing a lot about market structure. One of the biggest changes, really, I think, is the so-called quote unquote passives and the role ETFs have played in this. It's one thing, even if you're looking at a company with problems, and it's something when I was doing short research, and I co-founded 2 short research firms, my last one, when we were talking about companies, especially toward the end, we're talking in 2020 before I decided to leave, I would say to my folks, I would say, let's look at how much of this is controlled by people who can't be shaken out unless there's absolute fraud. They will be the last people to leave. And it would be, you'd see a company, and the first thing I started to do is I'd say, how big of a holding is this by ETFs? And if you see that 20 or 30% of the company is held by ETFs, it's just going to be tougher to shake them out. You really have to find something other than just a bad headline. But by the same token, the algorithms and computer algorithms, they've always been there. They've been there for a long time. They seem to be on steroids now. I actually am writing something. As we speak, I'm writing something that hopefully will be published. I'm sure it will be published by the time this is out. But I go from algos gone wild to algos on steroids. And just this past week, there were 2 very great examples of this. One was the cosmetics company, e.l.f. And this is something we were talking about. We have an internal chat at Wall Street Beats, my current home. And we have a chat that anyone can read, but we do it internally on WhatsApp, and then we port it over. And we have a lot of really serious pros there, right? People who are watching this day, and they have a great history. So I'm sitting there watching e.l.f., E-L-F, which is the cosmetics company, the online cosmetics retailer. And I happen to see that they just reported earnings, and stock just plummets. And plummets 10% or something like that. And I immediately go to the crew. I go, looks like e.l.f. fell off a shelf. And Jeff Mackey and Bernard Barchet, they work with me, and they're former hedge fund folks, portfolio managers, former analysts. And they both had immediate views on it that the company this expensive couldn't afford to miss. So the headline was, the guidance was light. But the next day, and probably one of the great reversals of all time, when the company had its earnings call, it had some commentary about expansion that analysts actually liked, and realized it didn't matter if guidance was like, that stock took off like a rocket ship. And so the headline, the algo was driven by the headline. And then you had the reversal because the headline is not what people are watching. And the other big change today, of course, you have the algos, right? You have the passives, but you also have the growth and the change in the hedge fund industry with the so-called pod shops, which are hedge funds that now have many different managers working for them, managing their own quote unquote pods. And the structure of that means they're going to be more tied to earnings and they're going to be using computer programs because they're trying to have good performance by the end of each day. So those things have changed the market. And I'll have to tell you, at the same time, Williams-Sonoma, just the opposite, comes out, beats, looks great. The stock is fantastic. Stock goes up. Again, we're talking aftermarket there. I think one was aftermarket, one was pre-market. I think Williams-Sonoma was pre-market. Then the company holds its earnings call. And then analysts start digesting what wasn't in the numbers. And what wasn't in the numbers were some interesting accounting issues, which I'm actually going to get into in what I'm writing today. That one of my colleagues, Kathleen Spurlock, who's a former short seller, she happened to point out immediately. She zooms in on that. She goes, while the stock is up, she goes, well, no one's paying attention to this thing they're calling out that's kind of very odd. The point is, algorithms hanging on headlines. They always have, but now more than ever. And with so many things, so many people, so many pods, you just have a very different market structure, which means, of course, in the end, good stock pickers can still do well.
You have an old post that I loved back around the GFC that was talking about your 5 simple lessons. And it seems like some of those, they sound the same, but a little bit more modernized. And I'll read them for listeners.
But they tell me what they were.
Yeah, the numbers don't lie. Quality, not quantity. GAAP isn't the same as a good housekeeping seal. Don't confuse stocks and companies. That's one of my favorites. And then risk isn't a 4-letter word. What's the modern interpretation of these? Because I love the accounting comment. I wonder how many people are really digging in there today in 2024.
Look, I'm not a numbers guy in the sense that I rely on others who do the numbers. And I think that's something also that is important, that when it comes to investing, it takes all types. It takes people who are involved in numbers, people who know the story. And if you put them all together and collaborate, you end up with, to me, the best research process. But I am very close to different accounting people. When I had my last research firm, my business partner, Don Vickery, was a really good forensic accountant. And one thing we came to the conclusion on is the numbers obviously matter. But one thing we also were very strongly opinionated on is accounting can lead you in a direction, but it shouldn't any longer be the reason you won't buy a stock or you're going to short a stock or whatever the case may be, or you're going to sell stock. Accounting is just a sign. And then you can use the different accounting metrics to bring them together. I think your other things you read, I wouldn't change one because those are still the basics of the market. I mean, the numbers still matter. But again, you start looking at how things have changed. And I go back and I think about in the older days, and I would have my very many sources and I would talk to so many people, and I found there are fewer people were raising red flags. So I decided to be the guy who did that. And part of it was also authentic to me because I tend to be fairly conservative in my approach to things and very skeptical. And so that played to me personally, and it just worked. But as I learned over time, the numbers could be misleading both ways. They could be misleading on something going down, especially with a growth company. When I look at the biggest mistakes I've made, right, and I look at some of the great mistakes, I'll say, well, let's see, this company's growing. There's some accounting issues. Is that like Monster Beverage? Monster Beverage used to be called Hanson Natural in the old days. It was a favorite for the short sellers. There were plenty of red flags. But what Hanson Natural was able to do was that Hanson Natural, as it morphed into Monster Beverage, those guys executed. It was literal execution that transcended any of the traditional red flags you would expect. Red flags, not only in the numbers, but red flags on, hey, these energy drinks look like they could potentially be dangerous. So you're drinking all this caffeine, you're going to have a stroke. And they also transcended something else. They out-executed the big players. So the thesis was Coke and Pepsi were going to steamroll these guys. If this is that good, they will be in the market. Well, guess what? Coke and Pepsi didn't steamroll them. They came in through the back door, guerrilla marketing, fantastic job seizing that market and really becoming a major player in the beverage industry. When I'm dealing with different companies, and again, I'll always ask the question, is this Monster? Or I'll say, is this Intuitive Surgical? I got Intuitive Surgical right and wrong along the way. And so when you're dealing with a medical products company, you want a med tech, especially some sort of device. I'm always saying, well, do they have something here the hospitals just need to have? Is it a need to have and they're going to buy it anyway? As was the case with Intuitive, which I think the bearish column that missed that every hospital out there had to have these. And there were doctors and younger doctors who wanted to use robotic surgery, even if there were various issues along the way, which I'm very glad I was able to point out. But still, just look at a stock chart. The company transcended all those concerns. And again, they had good management and they had a good pedigree going back. And I look at that and I go, it's one that I would rather have not written. And then you look at a company, again, you look at companies in streaming and you'll go back and you'll say, look at Netflix and look at the mistake the bearish thesis had on it. The bearish thesis on Netflix was very straightforward. Look at their off-balance sheet accounting, and that their off-balance sheet content creation charges and their off-balance sheet was a big part of the bearish thesis. It didn't matter because it transcended and really became part of life. And that's the issue when you're looking at fads versus frauds versus things that will work or won't work. I remember back in the day, and I'll show you the flip side of that, was way back. America Online, the original dial-up for internet service. There's a big short thesis around that. There are a lot of accounting issues around that. There are a lot of red flags, let me tell you that. And those red flags ended up actually mattering down the road. But the issue there is that anyone who was short the stock didn't understand if they were not plugged into what was going on with people getting online. They were missing the boat because that was something I know at the time I was certainly an early user of the internet, and people were increasingly finding out that this was a real thing. And so I think sometimes, again, all those things when it comes to accounting and numbers, you then have to look beyond that and go look at the company and what's really going on. And there's so many false negatives. Meb, you want to have something where you can reference it, but then something new comes along that may not follow the same playbook.
Well, you highlight a bunch of good stuff in there, Monster being one of the all-time best performing stocks. We mentioned we don't do single name shorting at our company, but have long been short defenders. The line that I traditionally use when shorts are getting maligned is I say they're kind of like the immune system of financial markets, where a lot of times the bad behavior, it's usually not going to get unearthed by the government or the long cheerleaders. But I don't know if there's any short sellers left. This 15-year romping, stomping bull market is the short funds in that world. It's hard, it's sort of thankless, but it takes a certain person. As like Wall Street beats today, and as you guys look around at opportunities, one of the key takeaways of everything you just said to me is the open-mindedness of looking at both sides, though. Like, hey, you're a long analyst. You say, okay, well, what are the other sides of this? Can I take the mentally short position and what are they thinking? And vice versa. If you're short, you're like, all right, well, do these accounting metrics, is that the big story? Or is it actually that this product is going to outgrow their problems? I don't think most people really think in those terms.
Well, it's interesting. When I did short research, the best things I ever heard, the biggest compliment I ever received was when someone would tell us, you kept us out of something. It was the smart analyst, and long only doesn't always do this, where they want to know the short story or the short wants to know the long story. What am I missing? And the problem with a lot of this is ego gets in the way. We're all susceptible to that, me included, where you get into something and you don't want to hear the other side. There's confirmation bias. You want to be proven right. And I look back and I've interviewed a lot of great investors, met a lot of great investors, listened to a lot of podcasts with some really fantastic investors over the years. And there's a steady theme. And the theme is they want to know what's wrong. And when somebody tells me that because of something I've written, they've re-underwritten their entire research and they've decided we're wrong, hey, at least they now are more comfortable. They have more conviction. And that's the role that the other side, I would say, plays regardless of which way you're playing a stock. And I don't short stocks. I've never shorted a stock. I've done a lot of short research. I've watched how hard it is. I've experienced selling short research and how difficult it is in a very strong bearish market. But what I now do, and what I started doing about a year and a half ago, because I know that the average investor doesn't care about shorting, but the average investor misses a bigger part of the story. And I have some friends who do quant research, and I sort of forged a relationship with these guys. They're called Kailash Concepts, and they're really wonderful people. And I started looking at just their work, and we started talking about avoidance. And the whole concept of avoidance gets lost in the translation of all of this. And so what I've done is I've created something I call the red flag alerts, which I've been doing. And it's just, I put out like the list has like 25 names now. It's not something I'm not doing deep research in these. I'm trying to flag them based on various things. And some of my best flags have come from the quant research, to be honest, just looking at them and saying that they have a few things and then I have to juggle. Remember, that's a starting point. So now you have to figure out certain things. And I just created my own little way of maneuvering them. Some have come from there. And that's also been confirmation for other ideas. But in looking at the quant research and looking at the ideas, one of the things I've come across is you have thousands of publicly traded companies out there, thousands of them. So if you're serious about performance, unless you're a highly speculative investor, unless you just like trading or whatever the case may be, you try to find which stocks are likely to underperform the market, which ones are likely to have more problems than not. And so I came to the conclusion that flagging those was more valuable than saying, this is a stock to short, because it seemed to resonate more. And actually, since I started it in May of last year, it's never been positive. In other words, the returns, the average annual return, some of them have done pretty well and I've gotten them wrong, or I've just decided they're not going to work for me. But the average annual return has been negative. They've been in the list has been in the red the entire time. That's the part that people seem to miss, is that what should I avoid? And in this marketplace, I like to talk about, so you have the art of investing, the sport of trading, and then you have gambling on the sport of trading. And those are the three tenets that make up this market right now. And one thing I've learned over here is that art of investing still exists for people who want to buy individual stocks. It's still there. The people who are wonderful at compounding still make money. They know it may be a little harder sometimes. And I did some long research for 2 years. When I left the business, the short side, I decided to get a little more positivity in my life. And I enjoyed that. And I enjoyed going back over certain companies. And the only regret I have is that I couldn't buy any of them because we weren't allowed to own the stocks.
I could spend probably 2 hours listening to you tell stories about some of the companies you covered. And I think listeners would love that. But I want to hear about at least one. I'll let you choose. I watched a fun video you did on Herbalife recently. It's about like a little 20-minute clip we can post in the show notes, links, listeners, which was a classic battleground stock where you had these big titans on both sides. Would love to hear your thoughts on that, or if you got any other particular ones you want to reminisce about, would love to hear it too.
No, I'll tell you, because I almost don't want to reminisce about the frauds because I've talked about them over the years and I don't need to go over them again. Those are ancient history to me. And there are people there have been much better frauds since then. So that's that. But Herbalife holds a special place for me because when I was at CNBC full time, this was a documentary I was working on. And we actually spent 8 months on this, independent of anybody else. The story was generated. I was talking to a friend who was a short seller. No, it was not Bill Ackman. We were having lunch in New York and he was telling me about Herbalife and he shared some independent research that had been done on Herbalife. And I took a look at it, but then I wanted to do my own work. The powers that be in CNBC decided we'd do this documentary. It ended up being actually an online documentary that we did. It was 20 minutes, but we spent a lot of time on it. And I flew all over the country interviewing people somehow related to this great story. It was interesting because it wasn't until the very end that I even knew Bill Ackman was involved. And I knew Bill because I've covered him and I've written about some of his stuff. And I think Bill's a really smart guy. I don't agree with him on everything that he says or does, but I do know how smart the guy is. Our own research with a team of several people who were doing the calls and we were going out interviewing people, we came away with the conclusion something wasn't right here. And then to have in the middle of all this, when you're working on a story, you knew the short sellers, in theory, me knowing half of these people would have been short the stock based on this thesis, even though, by the way, that kind of battleground is a very dangerous short, always will be. That kind of a story stock is to see what happened and watch what Icon did, where Icon could have easily agreed with the short and the concern. This was a group of all these short sellers, these hedge funds. They just didn't like what Bill Ackman said. And what was perceived to be his sanctimonious presentation, which was actually full of a lot of very, very good research. And they didn't like him saying this is not going to zero and everything. And then Icon decides to get in a battle with them. They go on CNBC and they have that famous battle royale between Bill Ackman and Carl Icahn. And suddenly people I know who would have been short the stock are long the stock. And I'm sitting there on CNBC going out talking about this on Fast Money and other shows. And in the middle of all this, knowing what I knew and knowing that we were working on this, and there's a great part of the story. We're going to go out and do this is a great story. So now we have to interview the company. Company does not want to talk to me. So we have several iterations. Once where the CEO comes out to CNBC, we're on air with the CEO and Jim Cramer, and there's a team. They were all kind of worried what questions I would ask if there weren't other people there. But then the real thing was we needed to get out and talk to this company and really talk to the CEO, just me and the CEO talk to him. They didn't want to do it. So we said, we're going to publish our piece and we're going to go on air with it. So suddenly it's come on out. So we go to fly out to LA. And even as we're flying out, they're debating whether they're going to do this. They want to kill the thing. So we're going to stay at the Beverly Hilton and drive up to the Beverly Hilton, and unbelievable. Herbalife placards everywhere. There's Herbalife. It's the Herbalife big world convention that I'm going to stay at the hotel of the Herbalife World Convention when I have been publicly writing about and we're doing a documentary on. So long story short, the next day we go to the Herbalife headquarters for our interview. And I say to the PR person, I say, I have to tell you right straight up, we're staying at your hotel where all of your people are. And they said, oh, we know. You were identified right away. Everybody was told. It was one of those weird things where, because I was
like, you need to send some minions, some like intern, get like Herb's guys to go to the bar and be like, here, just buy everyone drinks for the next 5 hours and just be like the bird on the fence.
The bottom line on Herbalife, though, is I knew there were issues there. You could tell it. The whole multi-level marketing industry has issues. I've written about them. They got off the hook. But as you can see, if you go back and look at their stock now, and as things have evolved and they can't use quite the same business model, it's sort of coming home to roost.
As someone who's systematic, quantitative person, we often talk to investors and say, look, it's like the Warren Buffett type of commentary. There's always the stock of the day. Today it's NVIDIA. Sometimes it's Tesla. Other times it's Herbalife. But I always tell investors, like, look, there's, as you mentioned, 3,000 stocks out there. You don't have to have an opinion on every one. You don't have to have opinion on 99% of them, and trying to find ones where maybe there's not 400 analysts following it is perhaps an easier task, I don't know, than some of these big ones. But it's seductive and alluring to be part of the main flow of the river where everyone's talking about something that's interesting. And I think it's a challenge for a lot of people not to get involved in today's NVIDIA or whatever it may be. Well, that's a fun story. I think a lot of people can recall that CNBC clip. That's got to be a top 10 CNBC clip for sure.
I have a feeling it got buried and forgotten because for a long time it looked like we were wrong. And maybe it was an embarrassing clip too for some people. It was certainly something I really enjoyed doing and have no regrets doing.
I want to hear about your new venture. It's funny because my career has also kind of spanned unintentionally writing, that when you're a young asset manager, you kind of have to write because you don't have any money to hire a bunch of people or do marketing or sales or other things. And so we kind of came more from the academic world on writing. But there was a brief period where I wrote for TheStreet.com before getting fired. I say fired lovingly because I never got paid. But this was back in the day when you had to, there was like the columnist conversation, but it was like an HTML editor. It wasn't like easy to talk to people. You had to like format everything.
By the way, I want to break in and tell you that you understand that columnist conversation at TheStreet.com and Fred Wilson, who's venture capitalist and was originally one of the original backer of the company, has said it since. That was the original Twitter. That was the original social media, if you really want to go back to it, the so-called columnist conversation, which was behind the paywall at realmoney.com, which was part of the...
Listeners, I'm sure you can go find some of my old posts. And if you look at the roster of people that were on there, it's pretty incredible, not to pat our own backs, but a lot of the other people that were there, it was the Twitter before Twitter. So after that, there was an idea, and you guys can find this online. This is 10, 15 years old now, but I used to talk about, I said, hey, I don't understand why someone doesn't do a co-op where you take 10, 20 of the best writers and say, hey, we're going to do our own website, essentially do real money, have a columnist conversation, have articles. I said, the difference is you can have the writers owning the website as opposed to a corporation owning it and have all the benefits of, we called it bloggerator back when people used the word blog aggregator. And I was like, you could do that for almost any vertical. And I would talk with Josh Brown and say, man, we got to do this. But then we got day jobs, got asset management companies, got to run. And I always wanted someone to do it in a way. And it kind of looks like what Wall Street Beats is.
Maybe the most exciting thing I've done. I hope it succeeds. I know it's a new business. So I say that because the skeptic in me will never believe anything, including what I'm doing, until I actually see it succeed. This is as close to what you just said as you can get all the way along. And the business, Wall Street Beats, actually started when somebody told me I needed to meet a friend of mine who's now part of our group, said, you have to meet somebody named Stephen Lamar. And this is about a year ago. And I didn't know who he was, but I quickly did some research. And Stephen is a very interesting guy who's best known perhaps for co-creating the Beats by Dr. Dre headphones, coming up with the concept of celebrity-backed headphones, creating this business with them and Dre and his team, and then ultimately suing that team in a 7-year lawsuit that lasted a very long time and winning, beating Hollywood and at that point, Apple. So Stephen's a very different person than I expect. He's a former hedge fund guy back in the day, doing privates back in the 90s and early 2000s in San Francisco. So he loves investing. His brother's a professional investor. His friends are investors. His passion is investing. He has several other sites he created related to investing that he's put together over the past 2 or 3 years. And he said he's always wanted to do something akin to a call he listens to with his brother and a few of their friends once a week, where they get on and just talk about what they're doing. Just talk about, it's that cool thing. Just what are they saying? What are they doing? And I said, well, that's interesting, because I've always thought it'd be fun to bring together a bunch of the smartest people I've met in my career and see if we could just bring them together. So I started making calls to some friends who, all of whom are formers. They used to be doing something. Some are retired. Some are, they just manage their own money. They manage their family money. They have family offices. But for the most part, they're not working for any entity. And one thing I found is these are people, because they're working by themselves, they were almost looking to be part of a group. They wanted almost a professional investment group to be part of, where they could start swapping ideas. Because just because you were an expert in oil and gas doesn't mean that's all you're investing in. You want to invest in consumer products. You were a banking analyst, a key banking analyst. Well, wait, no, you're investing in everything now. These are people who are very smart, who constantly are learning. We have one who's in his 40s, a lot in their 50s, a few in their 60s. We ended up putting together this entity, which is two things really, and it's evolving. As we're doing it, it's sort of like we're tweaking it, and we can see that the business is going to go a different direction. And we have a group of roughly about, I think we have about 15 people now, 13 or 15 quote unquote pros, people who, portfolio managers, former analysts, who are part of our group. Every day we do a call. We do a morning call. It's like the old morning call. We call it the round table. We have about 4, 5, 6 people on there, and they're talking about their ideas. So they all are making, it's not always a pitch of idea, because you can't always come with a stock idea. Sometimes it's just what you're working on, what you're thinking about, but they have their time and they come in and then they start talking. We have the round table where they start just chatting about what they're thinking. And we're looking for discourse. We actually want disagreement if we can get it, respectful disagreement in our group. We want to hear different opinions. And so that's one part of it. The second part of it, which is turning into something we hadn't counted on, is we have an internal WhatsApp chat. And that internal WhatsApp chat is just people just flying back and forth throughout the day. Sometimes it's quiet, sometimes it's very active, talking about things they're seeing, what they're thinking. And we also post that on the website in a form that also has an interactive version if people want to ask questions. And again, we're in our early days of doing this. And so we're finding that has a tremendous amount of great idea generation in its own, because these are just people talking and wanting to interact. So that's basically the business we've created, is that group. And then it's where I post my content, and all of our people, in theory, will be building out their own separate entities of their own content if they decide they want to work that hard. So We have put this together. We think it's pretty exciting. We like to have some fun, and we're all passionate. I think the one thing everybody here is passionate about is they're all passionate about investing. They're all actively trading. They're all actively investing. They're not necessarily trading. Many are very serious investors. They're all generally researching. Most of them, like I say, manage their own family money. That's what they do full time. And this is giving them an outlet, and we think it's a good business.
So what's really interesting about this, listeners, if you look at some of the types of media that have really resonated and become popular, if you look at the All In podcast and sort of the VC space, if you look at a lot of these ideas, this concept of looking over someone's shoulder, right? Where you have a group of experts, but it's almost like a setting where they're at happy hour or they're going on a walk or playing poker, they're chatting casually, discussing amongst friends. And it lets you, A, be a part of that group, but B, get insight into things they're probably not going to be posting on Twitter or LinkedIn. I've always loved this idea, and I actually looked it up while we were talking, and I was posting this in 2008. And so some of these ideas are timeless. I like it. What are some of the things that y'all are thinking about here in 2024 as you have these chats? Is it any particular macro or micro themes or ideas that people are particularly excited or worried about, et cetera? What's on your brain?
Well, I think what we try to do is we have one person who's very macro, and we have two very data-driven people in the group. And then we have mostly people who are focused on whether it's their sectors or individual stocks. I would like to say that we chat about the markets, we chat about the economy, we chat about whether we're in a recession or not, like everybody else. But what I've made a decision, and when I'm moderating these calls, and I do moderate several times a week, is I don't want this to be like everything you're hearing everywhere. It makes no sense. We don't need to be another voice just telling you that the economy is going to do X, Y, or Z. What's interesting is when Benjamin Bry, who's our youngest member, comes in last week and he goes, I'm shorting copper. And he goes, gives you the reason that he's now, and again, he's trading, right? Now, long-term, he believes in the copper as an investment, but he's a trader. I'm shorting it right here. That was a fantastic call. And then 2 days later, he comes in, he goes, I'm shorting MicroStrategy. I think, and he goes through and he's long Bitcoin. And he goes through the process of why he's doing that. And those kind of calls, or you have the people. So we like to talk stocks. We like to talk a lot, but we talk stocks. Or Jeff Mackey, who's just been so fantastic on like a Dick's, and he's talking about a Dick's Sporting Goods and why he thinks it's really good. Or we're talking about Lulu, which is one of his he's loved Lulu for years. And then I came out with a red flag alert on Lulu, wondering if Lulu is the new Under Armour and that it's basically best days are behind it. So I wrote a strongly worded piece on that. Jeff, who's really like the company, is rethinking it. So you start getting into some of this discourse about individual companies. Some are very small. We have one guy who just loves really small lottery tickets, but most of our names are in tech space. I have Paul Meeks, who's been a tech analyst for 20 some odd years, or Russell Young, who's a former hedge fund analyst. Yeah, they'll talk about NVIDIA. It's the stock of the day, but why they continue to like it and supporting it with evidence, or what the concern is with this company. Or Paul Meeks coming in the other day, he came in about 2 weeks ago with a Micron call. Micron was trading about 120 or so, or 115, 112, because I didn't buy it. I know it because I didn't buy it. And by the way, that's the other thing. We love the fact that people are talking their book here. That's the point. It's their money at stake. There's an aversion to thinking that people are talking their book, so that must be bad. And the reality is their money's at stake and their name is on the idea. That's their money and their reputation. So they have to believe it. So Paul comes in, he's talking about micro as a derivative play on AI that is, remember, not many people talking about micro. I like forward spin. So I was raised in journalism to create forward spin. And that is just taking a story forward. And so he gives the Micron story, he says, hey, I think this could be a $200 stock over the next 24 months. We have a new guy, Larry Peck. He used to be at SAC. He was their industrials. He ran their industrial silo. And he came in and he was talking about another derivative AI play, but actually a clean room play, an HVAC company, ANON. He's talking about this company that I know someone else is selling who's owned it for 15 years. Larry says, no, this is where it's a good time to buy it. I'm actually adding more to my position. So these are the kind of dynamics we have. I don't want to be just piling on with the same old names. Again, some names you can't help, but we also want ideas people aren't thinking about, or thinking about current ideas in a new way.
I think the skin in the game concept, listeners have probably tired of me talking about this, but we often cite the statistic that the average mutual fund manager owns $0 of their own fund. And we say, look, these guys are going on TV all the time telling you to buy their funds and they don't own any. To me, that is a pretty bad sign. You got to make your own decisions, of course. But if someone says, look, this is what I'm doing with my money, this is where I am, I appreciate that more than, hey, this is what you should do, I don't own any. That feels a lot more shallow to me.
And by the way, as a journalist, I couldn't own stocks most of my career throughout. I couldn't. And when I finally could, it was very different. And I often think if I could have, it would have made me better at what I did. But then on the other hand, as a journalist, and people were surprised I couldn't own stocks. There were, back when I had my column in San Francisco for 10 years, people always thought I was either front running the stocks or doing something. So you had to avoid that conflict specifically because it was a different role. But I also think you missed some opportunity because mutual funds, which were the vehicle's choice back then, different type of an experience.
100%. A couple random questions that would be fun to bounce around. We ask people, say, you sit down, and this could be you and the crew at Wall Street Beats, it could be you and some journalist friends, it could be you and just any pros in our world. And Herb says something, and 75% of the table shakes their head. So, like, meaning, what is a belief that you hold? It could be a broad-based belief, it could be a current belief that the majority of your professional peers do not share. So if you said it, they would shake their head and say, no, you don't know what you're talking about, dude.
I can think of several things.
No, let's do them all. Let's hear it.
One is something that I think is so elementary. And I guarantee you that any professional in this audience, I hate to say it, they'll say, this guy doesn't know what he's talking about. And they will just roll their eyes, laugh me off the stage, and just be out of here. And I'll tell you that for the average investor, I know your market is probably much higher than the average investor. I will say the one thing I've learned, because it's the mistake I've made, is if I could redo it, I would have been a dollar cost averager for 50 years. And unfortunately, because I was so close to bearish people, every single time I was going to commit more money or do something different, I'd be talking to one of my sources. The world was about to end. And one thing I learned over the course of my career, which is now 50 years, is the world never ended. Now, what I'm concerned about is that I'm such a great contrarian indicator that the world may be about to end for me saying that, right? And this is as dicey a time as ever. But I do believe that basic concept, which is everyone laughs off the stage because they all are so smart that they just don't see it. They do not see it. But that gets to my point number two. And I've especially applies to, I would say, many hedge fund managers. I would say it also applies to long-only mutual fund managers who often are so smug. We never talk about them, but they're often smug. They don't want to hear the short side of the story, and they think they're the smartest guys in the world, in the room. And what I've often learned is the simple concept I've used, I've written about it, is that hubris can be humbling. In the institutional investment community, it's just the person, maybe it's what drives people to it. They're competitive, they're former athletes, who knows what they are. But there's so much hubris that they can't see through their own fog of sometimes missing what's really going on out there, because sometimes things aren't that complicated. They're really simple. I hear these stories that are thrown at me sometimes, and I'm very good at try to untangle something and make it simple. It's one of the things I do pretty well. And over the years, I've gotten a little better at it. But I'll talk to someone, my brain will want to explode about some idea. I'll think about, what's the story here? What are we really saying? I did it the other day. We're talking about this Canadian trash company called GFL. And it's a complicated story, potentially a lot of stuff going on there. But one thing that resonated, and I was talking to one of the person I got the idea from, and the one part that really resonated is just a big gap between their GAAP and their non-GAAP cash flow. I kept my story to that because anyone who knows anything more will know, okay, what's really going on? If they want to do a deeper dive, that's where they start. So I think everyone wants to make things way too complicated. Sometimes they are, right? But I think so much hubris. And man, I think you have to keep that in mind when you deal with a lot of these folks. And I think it's tripped them up.
We said on Twitter, where no one's ever had a losing trade, that if I had to pick one single personality trait to give money to for an investor, it'd be humility, because the people that have been through it know that you have the scars to show, or you should. And if you don't, I feel like that's usually a dangerous person who doesn't realize
Well,
that.
I would think there's a reason for that, though, Meb. And I think one of the reasons is you get into the left brain versus the right brain. And I think the left brain can tend to be less empathetic and would have less humility because it's often so driven by data and numbers and can't see the other side. Like I'm a hard right brain person. So I remember when I did my research firm, we were pitching a major firm, and one of the partners there looked at us, and I had my partner as a forensic accountant and me, former journalist, and he said, I get it. Left brain, right brain. Brilliant, which is important because you can bring the two together and you'll look at the world in a very different way. And I sometimes think that's what's missing in the research on Wall Street. But again, there's so many left brain people who don't understand the way the right brain works. And I think that is unfortunate because I think those who do, and I've heard interviews with some portfolio managers who actually look for that combination, I think those that do get a better end product and wind up with a more rounded level of research.
It's going to be tough for you, but as you look back on the career, since you largely were not doing individual investments, what's been the most memorable story? Is there one that you're like, oh man, that one is just seared in my brain as the one that I can't ever forget? And it doesn't have to be the biggest, just the most memorable.
There's the one fraud that I once did, the biggest fraud in my career. And I hate to talk about it because it's just so far in the distant past. And it's this Media Vision. It was a tech company in the Bay Area. And it was just really I had a lot of fun. I did a lot of research on it and really was able to dig on it, even though I was doing this 6-day-a-week column and doing all these other things in San Francisco. It was one where I was able to take almost not a sabbatical, but take a few weeks off and actually do the work. And you ended up having a CEO go to prison and a CFO go to prison. And the CEO, I know years later, just continued to tell people what a horrible guy I was. And he was nailed every which way from Sunday. And that was a favorite, but there's so many. I mean, look, I had a front row seat to all of the changes in journalism. I had a front row seat to being there from the early days of business pages being behind the sports section to watch them evolve from outside of that to be their own thing. And then to become, in its glory days, the online journalism. And I made that transition. I was the first journalist, really mainstream journalist with a sort of a quasi name to make that jump when I went to the street.com, and people thought I was absolutely nuts. And so I've watched that transition. I've been part of that transition. And I've watched just even the competitive nature of journalism change, where we could go from the street.com trying to break stories and beat the New York Times just because we could get it out 6 hours earlier. And they were still stuck in the old way of, in those days, there's online journalism and print journalism. The same organizations would separate them. And the people who were doing the online would be, as I recently wrote, that they were the farm team. The A team was on the print side. As we now know, it's all morphed and doesn't matter anymore. So it's hard to pick them out. I've had a lot of fun ones, even from early in my career, or real early before I was doing what I'm doing now. There's just one after the other. Interviewing Gregory Peck at the Boca Raton Hotel and Club many years ago, 1974. That was fun.
Yeah, that's a good one. I was just reminiscing a little bit because the first time, and I don't know how long, I had lunch where we were at a restaurant and CNBC was playing during lunch. It used to be during the late 90s that was every TV, every restaurant during lunch. And then for a long time afterwards, it was not. It was sports or anything news. But I started to see it again. I was like, it was a little warm place in my heart, seeing the sentiment. It only took a 15-year bull market. I don't know.
This is really interesting because before the internet, I had my own little corner of the world in San Francisco when guys like Kramer would have my column faxed to him because they knew that I was able to have some stuff that wasn't broadly disseminated. So the inefficiencies of the market in that kind of research still existed back then. But I have to tell you, when CNBC came on, we had a TV up there. I'd be watching it, and this is before the internet, and David Faber would come on, and I'd see him, and I would hold my breath. And maybe it's just the competitive nature of me. And I don't, for some reason, I always think I'm writing 6 times a week, and I'm in the middle, 2:00 in the afternoon or whatever, and I got to write. And I'd hold my breath and say, please, oh God, don't be talking about what I'm about to write about here. That was how it was back then. And then obviously, it's all a different competitive landscape today, my friend.
Well, look, this has been a lot of fun. Definitely listeners got to check out Wall Street Beats, Herb's new venture. Any other places they find your writing? Where's the best places to go? Substack?
I'm morphing everything. I was doing it on Substack. I still have a presence on Substack, but Wall Street Beats is my home. I hope it's my home for a very long time. I hope it outlives me, which the older I get won't be a problem.
Herb, it's been a blessing. Thank you for joining us today.
My pleasure, Matt. It's great fun.